I could never go on vacation. Running my renovation and contracting business took up all of my time until I found Jobber.
Purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Let's get started.
I still have to update that live pin thing going on. I've still got that old announcement in there, so it keeps showing up. All right, welcome to the Financial Advocacy Podcast. We're back on a whole other topic here. And Alonzo, salute to you, my brother. Always glad to see you. We're going to cover investing as best as we can cover as non-licensed investment people. But I've had some experience with this stuff. And Mike, I don't think you ever held any of these licenses in the past. Your screen is frozen for me.
No, you're fine for me. A securities license is one license that I've actually never held. I've had just about every other license, but no 663, 7, any of those. So.
All right, so you never had a 763. There we go. And and of course, Alonso is pointing out the First Amendment for us. We know because he's going to restream, and just because you don't have a license doesn't mean you can't talk about it. Absolutely true. And as we have in our disclaimers, we're going to cover the stuff that usually they can't talk about or are afraid to talk about.
Well, that's exactly what I was just going to say is because we're not licensed, it may give us actually a little bit more freedom to talk about this stuff, as ironic as that may be.
Absolutely. But look, you're coming in pretty jarbled, and I don't know if that's you or me. I'm going to assume it's you. Because I don't have a weak connection, at least according to my settings here. So
am I better now?
Go figure. Yeah, security license folks can't say stuff while we actually can. The main thing is that we're not making a recommendation. We're not telling anybody to buy, sell, hold. We're not making any analysis. Although I will talk about some analysis tools that I happen to like. We'll talk about some formulas. We'll talk about some definitions and things. The first thing is let's talk about the importance of investing for the future, because if we don't, are we going to make some progress in the future? Generally not. And I'm counting in this equation cash value life insurance, even though it is not a security. It is part of long-term investing, depending on how the policy is structured. And I know I hate saying that phrase. As long as the policy is structured properly. I'm so tired of that phrasing.
I mean, life insurance is not an investment. So,
well, it is and it isn't. Real estate.
Depends on
real estate can be an investment, but it's not necessarily a security.
Yeah.
Collectibles.
I guess you could say a variable policy would be about as close as you could get to an actual investment.
That is a security, yes. And those are regulated by FINRA and the SEC, only offered by prospectus by those who are registered representatives who have a Series 6 and 63 at the very minimum, and they're sold through broker-dealers. There's also fee-based alternatives that are out there. I don't see any reason to ever offer them, but they are what they are. But is life insurance an investment? Let's cover that real quick. Yes and no. And I'm going to say yes in the fact that we're building it for a return. It is not at risk in the market. It is not a security, but we are building up an asset. And we don't have to do it. No one's forcing us to do it. It's not like homeowners insurance and auto insurance that we talked about, a few weeks ago and all that stuff. Those are requirements. And yet, choosing to purchase life insurance is an investment of what you want to have happen for the future. That's as simple as we can make that. It is not necessarily a security. It is not necessarily subject to the investment and oversight of the SEC and FINRA, although they'll monitor the investment, the insurance companies, as well as the state regulators, all that stuff. So is it an investment? It is not a security. That much I could always say. Is it an investment? Yes, in the English definition of the term investment, not necessarily the regulatory term of investment. So
It
I'm
depends.
always trying to be very cautious of terminology, right? Because I don't want to get anybody in trouble. Um, Alonzo says, question from the audience: any thoughts on Trump wanting to make USA the crypto capital? Here's what's interesting is, I saw some of that in the recent news. And even though this is normally under financial literacy, we're not talking about current events, but this is interesting and timely. I was looking at those things, and the fact is that they want to add it into the treasury, I think. But the thing is that the United States is not an issuer of the of crypto. It is not our currency. So just because they want to make it an additional asset does not mean that now crypto is now the currency of the United States. We have to make sure we make that delineation. So the same reasons that people are cautious of crypto, or the exact same reasons that people buy crypto. It is not backed by any government entity. Just because the government buys it doesn't mean that it's now backed by the government. It just means that the government can now be a beneficiary of whatever the holdings are and of those returns. So it's an interesting thing. It's the same thing with Mass Mutual, 5 years ago. I think they bought like $1 million worth of crypto at the time. Obviously, it's done well, assuming that they've held it. But I think they got more PR press benefit more than they got return benefit at the time. So it is what it is. But just because the United States government may be buying it does not necessarily make it a suitable investment to be ever recommended. And we're never recommending anything anyway. I'm not saying that the public should be buying it. I find it interesting that they're trying to make it more legitimate that way. So I'll give it that. Alonso's saying 100 million. I don't know if it grew to 100. It probably grew to 100 million for what Mass Mutual did. I can never get the MMs right. That's not thousands, that's millions, right? So yeah, 100 million? That doesn't sound right to me. I'd have to look it up, but I don't want to take the time to do it now. So
It is.
let's to the interesting stuff. What has I'm sure everybody's heard of the question, and the first time I think I heard this question ever asked, I think it was in the movie. Oh, what was it called? It was back in the 80s. And now I had it in the tip of my tongue, and now it's gone. But I can't remember it now. But it was that one teacher going into the hood, and of course it's LA, so it relates more to Southern California. And he's teaching these people, these students, he's getting into calculus, stuff like that. But one of the questions he asked early on, I think it was this movie: would you rather have $100,000 today, or a penny doubled every day for 30 days? And of course, that's a math question. That is not an actual investment question, because nothing doubles in value every day for 30 days, 30 weeks, 30 years, nothing. So it's a math question. How good are we at our math? And so I'm going to share my screen here. Think about it. And if you guys are watching and listening, Alonzo did my homework here. Along with a $5 million equity investment in NYDIG, Mass Mutual also purchased $100 million in Bitcoin for its general investment. Okay, cool. I don't mind being wrong. I'm okay with that. I really am. I am secure in not only my masculinity, but in my intellectual capacity to be wrong. But
the question is, are they still holding it?
Yeah, who knows? My guess would be probably. I don't know. But anyway, for everybody that's watching and listening, put it in the comments. Would you rather have $100,000 right now, or a penny doubled every day for 30 days? And in 5, 4, 3, 2, 1, we got the comments of 0 here. So I'm going to give you the answer here, because I have a spreadsheet on this thing. Alonzo's saying a penny. He gets it. Now, granted, all of it also assumes that if you know what the math is, what else could you do with $100,000 today that might do better than what that math is? So that's always a question, right? Once we know it. But let's share the screen here. And on the left here, a penny doubling for 30 cycles, whether it's 30 days, 30 weeks, 30 months, 30 years, doesn't matter. 30 cycles, penny doubling every day. And let's see, can I zoom in further Almost afraid to, I might lose my spot here. Okay, 200%. Let's do that. Here we go. Okay, so at the end of the 30th day alone is $5.3 million. The 30th day alone, according to math. So if the cumulative total, you add up all the days, $10.7 million. So if you chose the $100,000 on day one, you just lost out on $10.6 million. I mean, darn. But the thing is that what would you have done differently? That's the biggest question there. Now, using this as a model of our decisions, what happens if we happen to skip one day of compounding? So that's why I highlighted this cell here. So a year or period, day, whatever it is, 15, we did not double. It just stayed. We did not lose our values. It just stayed even. No gain, no loss. We stayed even. What happens? Well, at that point, we just lost one day, and our cumulative total is $5.3 million. Again, nothing acts like this in real life, but it models what can happen. So we lost out on the back end, right? That last 30th day was not as high as it could have been. Now, the neat thing is about this is that if this was real life, which it never will be, you wait one more day and you've got your 10 million, right? It's not a big deal. But let's go down further. What happens if we have a penny doubling every day for 30 days, but we withdraw it all and start again on day 7? Because here's the thing. This first 10 days, in fact, heck, the first 20 days, there's a very technical term for this. Let me give you the technical term. What do we call this part? It is boring. Telling you that right now. This is the boring part of financial stuff. It is not fun. You just, but you have to stay the course in order to get the high payout later on. So here, on day 7, we not only did not double, we took all the money out. And then we restarted the clock again. And at the end, again, this is a modeling of what would have happened. Your cumulative total is 83,000, not 10.7 million, 83,000. That's the power of compounding if this was actually something that could happen in real life. So again, this is modeling our decisions. Now, that's in the first 10 days, 10 periods, whatever it is. Let's move over here. What happens if we did it in the second period? We did it in day 16. We took everything out and we started the clock over again. Yeah, $500 cumulative. This is where we say you effed up, right? You screwed up. Or, let's be fair, life screwed you and really did a number on you. Okay, because that could be, maybe you had these huge medical bills that took it, or maybe you got sued and it took everything away, got divorced. Things happen and it messes everything up. And I'm going to reference Tom Hegna's book here, Who Wants to Be a Millionaire? I reference it for 2 reasons. One, it's a very good book, and 2, I'm in it.
I knew that
Mike's
was
shaking his
coming.
head at me. Yeah. Well, if I can't cite myself, I'm going to be citing myself a few times. But the thing is that if I'm citing myself and it's terrible, then you all would call me a fraud. So I'm going to cite myself because it's good. But in here, he talks about the 2 biggest wealth drains, which is divorce and cars. How you pay for your cars can impact how much wealth you have remaining to compound for you, and divorce, which because it cuts out everything, not to mention child support and alimony. So I'm just saying that if you can help avoid the wealth erosion from some of those areas, you're going to be that much better off. Alonzo saying, this could be a case study for the use of an IUL. I'm an IUL. I know you're an IUL guy, and I know that you do it the proper way. So I have no qualms on that. IUL, as we've talked about before, has performance risk, even though it does not have market risk. And we know that. And we covered all that before. And we're not anti-IUL necessarily. Usually we're just about, he is, if there's places where IUL is better, I just want to see it as much as I can do it contractually guaranteed as much as possible, which normally just means it's an IUL contract with non-lapse premiums. There's different stuff that's out there. So, yeah, you can invest using the IUL, but the thing about the IUL is that it's not directly investing in anything. You're tracking the index performance from year to year or year to every 2 years, whatever it is, however it's allocated. Okay, do I have another thing?
Yeah.
Yes, I do have more here.
I don't want to go down
Penny
that
doubling
road.
for 30. Fair enough. Yeah, we're not going to argue, but that's all right. We're good. What happens if we have a market dip a few times while we're growing our wealth? Well, how do we monitor that? How do we do that? Well, I had to manually put in, rather than having an Excel formula, I had to manually put in different numbers. So here, instead of 16 cents doubling to 32, it took a 25% dive. So from 16 cents down to 12 cents. And then we doubled again from there. Now, doubling makes everything easier. But I did that, 5 times? 1, 2, 3, 4. I did it 4 times. So instead of the 10.7 million, you have a total of 212. Again, all the money is just growing. You're leaving it alone. You're not withdrawing it at that point. It's just the market doing what it does. And that's how that can erode your wealth. Again, that's not even in your factor that you can control. And I hate that, because sometimes the way some planners tend to work and their investment only focus, they create victims of their planning instead of winners because of this kind of buy, hold, and pray mentality. And they think, oh, just hold on, just hold on. No, if I was able to keep, again, everything being hypothetical, if I was able to keep that money growing consistently, it would have been 10.6 million. Now you're telling me I have to be happy with 212. Again, using this as a model. Now, what happens if we wait too long to get started? So let's grow that here. If a penny doubling every day for 30 days, and yet what happens if we wait 5 years to get started? Where's the cost? And the cost is in the back end. You don't feel it up front. The cost is later. So instead of the 10.6 million, you have 335,000. Cost you about 10.4 million, assuming that that model could actually work out. What happens if you wait 10 years? 10.5 grand. So I wanted to use this as a model of how our behavior impacts our investment results. And in addition, sometimes, how outside influences can impact things. So what happens if you wait 10 years and you had those market declines? I didn't do that one yet. I'm just saying, combine the two. That's a reason why not everybody has the wealth that they can have. Or
We can guarantee it's going to be less than 10,500 though.
Oh, I can guarantee. If there's anything that I can guarantee is that, one, if you don't invest, you won't get any return at all. And 2, you are not getting a penny doubling every day for 30 days or 30 years or 30 cycles, whatever it is. It will not
30
happen.
anything.
30 anything, because nothing happens that way. So that's that one. Now, there's a lot of criteria. Let's go here. I have the blog article. Again, I'm citing me. Of course I am. But I've done a lot of this stuff to Mike's laughing at. I'd laugh at me too. I agree with you. But if it sucked, we would all know it by now. So for any given bucket of money, there's 7 criteria to evaluate for comparing capital investments. So what do we got? The first one is risk. And also, usually when we're thinking about the risk of loss of the lump sum of capital to be invested. And unfortunately, we can't always tell the future, but we can look to the past, even though every disclaimer says, what does it say? It says investment performance or past performance is not an indication of future results. So that's always there. Remember that the word investment can be code for can lose all your money. In 2008, which was the biggest free fall, and this is why I keep referencing it, it was a free fall of 50% of the market in 2 months. September to November, it was a free fall. I couldn't believe what was going on. Before that time, we thought, you know what, the market will ebb and flow. Down 10%, up 10%, maybe down 20%, back up 20. It was not a free fall. Question: when investing, is there a concrete minimum dollar amount to have a likelihood of substantial returns? No. Most of that is going to start with behavior. I mean, this is something I give. There's a firm called Edward Jones. And Edward Jones actually has done a great job with this. And in fact, my parents were an Edward Jones client, let's say 30 years ago. And they got started with $25 a month. And that's actually the minimum that American funds will let you open an account with. Start off with, $25, and they debit your account $25 a month, and it just grows. And so behavior going into your plan is far more important than let's pick the right thing. Because quite frankly, you could be in something that is not the greatest, and you'll probably do okay long term based on past precedent, right? I got to couch everything. So no, there's not a minimum concrete dollar amount because different firms will let you do it. The question is, what is it going into? What is the risk? But I did this presentation 10 years ago now. It's on my YouTube channel, Risk Tolerance and Recapturing Investment Losses. It still holds up because I go through a lot of these things we're talking about here. By the way, do not confuse risk with volatility. Risk is in relation to the volatility. So volatility is your investment to the benchmark index. But we have to make sure that the benchmark is an appropriate benchmark for your risk tolerance. So the first part is determining your risk tolerance. And I got a whole thing on that one too. The second part is how is the investment behaved compared to that risk tolerance? Oh, kinds of fun stuff. So return. You have risk, you got return. What kind of return based on the past can we sort of anticipate? And generally what we're looking at is the higher the risk, the higher the return. But there's also a great phenomenon, and I think it's called value investing, where you can take a lower risk and get a higher return. And I love that. That keeps people invested. That keeps complaints away. I like it when I can have a path where people will stay invested and not get nervous as much. Like I talk about in my favorite funds, they went down, 30% and 40% back when the whole market was down 50%. I mean, no, I wasn't at that firm anymore, but I would have been saying, look, we're down 30, could be worse. Now, 30 sucks, but it still could be worse. So we have risk, we've got return, we've got costs. What are the costs of investing? And this is a lot of how is the broker or advisor being paid? And that depends on your time horizon, right? Are you investing for 5+ years, or it really should be 3 years plus, or if it's going to be short term? And by the way, the shorter the term, the less risk you should be taking with that lump sum. So I've had people in the past, they said, well, I just want to invest for a couple of years. And this was before 2008. And so I put them in something that was moderate, very, very moderate, rather calm, I would hope. Once 2008 hit, the rules went out the window. And now investment advisors should be far more conservative and be declining some of those transactions. I wouldn't want the risk and liability on those anymore. I'd say if you really want to invest in that, go to Fidelity, go to TD Ameritrade, go to, wherever else, do it yourself, because I don't want the liability. But so anyway, there's different costs involved. Now there's terms. Everything has different terms available. It just depends, like annuities have their different terms. Annuities have, I call them house rules, and then they have IRS rules. Got to know the difference between those two. And will those terms fit in your overall objectives? It's just something that has to be kept in mind. So just because you have something that has a great high risk, high return, doesn't mean it's still right for you, depending on the terms and conditions of what it is. Agent or advisor compensation, it is and is not a factor. The main thing is the agent or advisor, are they doing this for you or are they doing this to you? And unfortunately, it's hard to know. I heard this great line when I was at the business planning summit. They said, "This looks great for your advisor. It could be good for you." I'm going to start using that far more. I got to bring that in my vernacular. Looks great for the advisor. I don't know if it's good for you.
It depends.
And of course, I brought up it depends. That's right. There are other intangible considerations with benefits and drawbacks. So, and then the final one is tax considerations. What are the tax implications of everything? I probably should have reordered that and put that higher up. But these are the criteria. Does everything kind of fit in line? And I'm looking at this like, if I were in the client's shoes, would this make sense to me? Would I want to go forward based on what I know about the client and their goals and objectives? That's what I'm looking for. But let's talk about risk tolerance and bias there. So that's another blog article, but it's based on FINRA. FINRA has been doing these financial capability studies at least since 2006, 2005. They've been doing it for quite a while. And this chart, by the way, I got out of Tom Hegna's book, although I got it from the Kindle version because that one's color. It's not color in the book that's printed out here. It's black and white. Tom went cheap on that part. It's not even color. But here's the cycle of emotions: optimism, excitement, the thrill, the euphoria. I want to get in because everybody else is making a ton of money and it feels safe, right? You got this mass market euphoria, mass market sentiment. Everything is going gangbusters, and then all of a sudden things start going down. Here's the anxiety, the denial, the fear, the desperation, the panic. We got the stages of loss.
Yeah.
At some point you got the bargaining kind of a thing, and by the time it's like, no, that's it, I got to sell out. And that is a time when you should have stayed in. And in fact, if you could have stayed in, you should have put more money in, because we make money when we buy low and sell high. Not let's feel good and then feel bad and make our decisions accordingly. If we could take the emotions out, that really helps. So here's the interesting thing. I've been following this study for quite a while. This, where was this? This was in which year? The 2009 study. So this is right after the crash. And I'm sure we had 2008 respondents here. But how willing are you to take risks? 45% say not willing. That's a pretty big number. 42% say they're neutral, which then if I'm an investment advisor and I'm going to be advising a client, you say neutral, I have to say not willing. I got to play with that a little bit. Like if we go up 10, but you can lose 20, is that going to be a problem? You got to figure out where their fear factor is, more or less, because it's a pain factor. That's what risk tolerance is. It's how much pain can you tolerate in looking at your statements, which is why so many people in 2008, they didn't even open their mail. That's probably one of the best things that people should do at that point, depending on your time horizon. So 2009, 45% not willing. Now, the 2012, what happened since then? Market had been creeping up. It's been doing better. Guess what? Now it says 35% are not willing. Now, what did that just prove? It just proved that when people feel better, they're more willing. And they did it again. Here's 2016. Guess what? 30% are not willing. Guess what? What's been happening? The market keeps going up. So FINRA's own study is confirming that when things are going well, people are more apt to take risk. And that's okay. But now when they did their latest version, they don't include that question anymore. So they don't ask that question. Maybe they figured out that there's been a pattern and it's not helping their brokers sell. So whatever, I don't know. I do find that interesting. So this is one of my favorite charts. Once I've seen it, I share it. It's not mine. And it's pure math, even though Crestmont Research. You go to crestmontresearch.com. They have all kinds of great reports and things on there. Here's the neat thing about this graph. Now I'm going to zoom in some more because I can. There we go. Okay. If you lose 10% in a given year, what's the return that you need to get the next year to get back to even? You need 11% gain. 10 versus 11. Okay, that's not too bad. If you lose 20%, you need 25% to get back to even. What happened in 2008? We went down 50%. You need 100% gain to get back to where you were. How many years did it take? And I've shared this before and I've shared it in the other presentation. It took about 4.5 to 5.5 years to get back to where you were, assuming you weren't selling out of your portfolio. You're not in retirement taking distributions. You're not panicking and then putting money back in, because you can't day trade your mutual funds. They don't like that. You day trade ETFs, but you can't day trade mutual funds. Realizing this and how quickly losses happen compared to investment returns, this shows how much more cautious we need to be, and we should be as advisors. Investment advisors should be far more cautious. It's just, and by the way, 90%, you might say 90% will never happen. The stock for Zoom went down 90% from its high in 2020. And of course, why did it go so high in 2020? Because pandemic, everybody's doing online web conferencing. But ever since then, I've got the chart on my Facebook feed somewhere. It did go down 90%. I'm like, well, there's an example. That's one stock, by the way. And to get back, you need a 900% return to get back to even, which basically means it will not happen. You're not going to get your money back from Zoom if you're following it down to the bottom and trying to wait for it to come back. There's only one way it's going to come back from that, and that's if, and maybe we should say when, the next pandemic happens, and it is either real or government manufactured panic, and we're all told to stay in place, and we go from there. It is what it is. So that's a great chart, because the perception of small losses take huge gains to get back to where you were, and you've got to have the time to get back to it. There is a phrase, and one of the most prominent speakers of our industry, Van Miller, he says, where is it written in finance that you have to lose 30 to 50 to 70% of your money to make money? And I know exactly where it's written, because the saying is, let me get it right, volatility is the price we pay for higher returns. That's the phrase. And that was said well before 2008. I don't think too many people are really saying that phrase anymore. At least I really hope not, because we've got far more people going into retirement. What was it? The retirement red zone is the 5 years before, the 5 years after retirement, because that's when your greatest risk of the ripple effects of those risks really compound through the rest of your retirement period. Alonzo asks, is there an average time horizon for investors? It depends. There are some people who want to invest so they can buy a home. Like, okay, well, what are we trying to do for that? You just want to get enough for the down payment. What are you investing, compounding, whatever it is going to be? Are you investing towards retirement? And again, if you're investing directly into mutual funds and such, that's a long-term play. And if you're doing dollar cost average, go ahead.
If you're, depending on your age, right? If you're planning for retirement, that could be a 40+ year horizon, depending on when you're starting.
Right, exactly. And dollar cost averaging helps you to buy shares lower that would theoretically continue to rebound over time. And I say theoretically because just because it's always been that way in the past does not necessarily mean it's going to be that way in the future. But here's the thing about institutional money management as opposed to personal planning, because institutions will manage funds for 30, 40, 50, 60, 80, 100 years plus, because the institutions are going to be forever entities, essentially. But when we're investing towards our own emotions, we're investing towards our own security, and we're investing to one day spend, which is why there's these rules of thumb, like, what's the rule of thumb? It's take 100 minus your age, and that's the amount you're supposed to have in stocks, once you're in retirement. So if you're 70 years old, you should have 30% of your portfolio in stocks, 70% in bonds, and that's a rule of thumb that may or may not make sense. But the idea is to preserve more of your capital in something that is presumably safer, so that you have your money for your spending needs. So that's that rule of thumb there. But yeah, average time horizon, it depends on what they're investing towards and what their purpose is long term. Now, I have a completely different idea on that. And you can use IUL or whole life, almost doesn't matter. But you can use what I write about in the book. So what I write in the book, well, I've written, and but I'm on the back cover too. I'm bragging. I know, I'm sorry. But I didn't tell him to put me on the back cover either. I mean, that was Tom Hegna's design. So he quoted me back there. But what I basically say is the problem in the markets is that when all of your money is already tied up in the markets and the market goes down, what extra money do you have to invest? You generally don't have any, right? All these people saying, this is the time to buy. If you've already been buying all this time and your situation is optimized, you don't have any more money. This makes you at least a temporary victim of the stock market, depending on your stage in life and what the funds are for. What if you had a fund, a reserve fund, that when the markets go down, you have access to cash and capital? When you have access to that, you can put it into the market. Now, when do you want to do that? Probably when someone from the government says we're going to stimulate the economy. Sounds like a violation, but still, it's a stimulation of the economy. They're going to put more funds in there, which means somebody's going to benefit from that. And if you have capital and you could put the money into the market or into your own business, maybe other people are going out of business and you could buy their inventory and you buy it for pennies on the dollar. Whatever it is, you have capital. You can take advantage of opportunities. So that's what cash value life insurance can do. So while you could do this within an IUL, not necessarily as much with a whole life, because the whole life is a fixed return. Depending on dividend performance, it does what it does. But you can borrow against either of those policies because you have the cash available, put it in the market, put it in inventory, whatever it's going to be, hold on to it for a long period of time, sell out. Well, can't do that with inventory, but sell out when it's long-term capital gains. So you want to hold on to it for 13 months or longer, keep the profit, repay the loan, keep the excess. And go ahead.
I believe, you can correct me if I'm wrong, but if you've borrowed the money with the purpose of making a profit, you can write off the interest on borrowing the money as well, as long as it's held for long term.
And I have not necessarily looked that up in terms of investing. I think that the tax publications do support that. I've never promoted that. So that's tax advice. We're going to talk to your accountant. But as far as for a business, if you're doing this to buy inventory and such, by all means, yes, if you're buying inventory, you're buying real estate or something, and you're buying it for a purpose of profit, definitely that works. You're going to flip the real estate. You're going to buy it for rental purposes or whatever. I'm not 100% positive on that for securities. And I'm just not positive on it. So that's something to definitely check with your tax advisor on as far as investing outside of a qualified retirement plan. So this has to be brokerage, after tax stuff, if you're going to do that. So I've never mentioned that or recommended that. I do know that the fees, if you're working with an advisory firm, the fees are tax deductible.
Right.
To a certain point. I can't recall what that is right now. But anyway, there are some advantages there. But having access to capital when no one else does, you can take ethical advantage of opportunities. And that is a beautiful thing. I want to see people become winners of their financial planning, not temporary or possibly permanent victims of, in my opinion, inferior planning, just because it's easier. It's easy to talk about just invest, buy, hold, and pray. Pray to which God? I don't know. I don't care. But I mean, it's just, I hate seeing that. And that's what happened in 2008, 2009. People were just, their life savings were decimated. And so, you know what happened that year was Nancy Pelosi made sure that the government decided to waive RMDs that year. It was the past administration. They screwed everything up. We feel your pain, so we're not going to make you take a distribution out. They figured out that if you take a distribution when the values are low, they're not going to get as much tax revenue. Let's wait for those things to go up. Let's collect higher taxes on a higher balance, so that they're on a buy, hold, and wait and pray and such, so that the government benefits. So, okay, so that was that blog article. Now, I've been talking long enough, I think. One of my favorite resources, if anybody's ever looking for stuff on mutual funds, I like Yahoo Finance. And the reason I like Yahoo Finance, I'm going to scroll up here to the summary. The reason I like it, it gives you all the up-to-date stuff, at least within the last trading day. It is what it is. And I use these two funds, Capital Income Builder and Capital Road Growth and Income. I just use that as reference. They were the favorite mutual funds I was selling back in the day. And this is as of today, which is March 4th. Command Day. Sorry. March 4th. Sorry. I'm getting campy now. But the neat thing is that when you go here to risk, Mike's going to laugh at me. That's all right. Okay. You go here to risk, and the risk part gives you the modern portfolio theory statistics. And I happen to like being able to see that stuff. Now, it's going to show them over a period of time. In this case, 3 years, 5 years, and 10-year period. What is alpha? And I'm going to show it because I prepared for this. Alpha is the excess return of that investment compared to its expected return based on the risk level and outperformance or underperformance relative to the benchmark. So whatever the benchmark is it doing better or worse than the benchmark returns? We want a good alpha, and alpha is represented with the number 1, and I want it to be greater than 1 for a greater return. That's our alpha. And in this case, and I'll just zoom in for the 3-year. Here we go. So now you can see it. So for alpha for 3 years, 1.21, which means it's essentially 20% better of a return, not 20 percentage points. It's just 20% better. It's a statistical number. That's what it means. So that's for the return. Beta, no, we're not talking about males here. Alpha male, beta male, all that garbage. No, we're not talking about that. This is all statistical analysis. Beta measures the volatility. Scrolling at the bottom here. It's a longer description. It measures the volatility or systematic risk of an investment relative to the overall market, with beta of 1 indicating the investment price tends to move in line with the market. Values above a 1 is higher than the market, higher risk. Values below a 1 is lower risk. So here for the 3-year, it's 0.92. We're pretty close to the market performance of risk. In the past, it's 0.96, 0.97. We're right in line there. The mean annual return is average yearly return on the investment, calculated by summing up all the annual returns over a period divided by the number of years. So that's just the mean annual return. And again, it's a statistical number. It's 0.46. That's not 46%. It's the statistical number. R squared is one of my favorite benchmarks. And I doubt my old securities mentor is watching. I haven't talked to him in a long time, but he taught me this. R squared is the percentage of the return is attributed to the market. So in this case, 92.4 for 3 years, 90.85 is 5 years, 89.9, 10 years. So it's trending that more and more of the return is coming from the market, not necessarily the management. But the inverse, means that 10% of those returns are coming from the management of the fund. It used to be back in 2007 when I was selling this fund, it was like 0.56. So it had in my opinion, a high talent index, which means that the management was really the ones generating the returns. So again, that's one of my favorite statistical things to look at. Standard deviation measures the dispersion or the volatility of an investment return from the average return. So how volatile is it? Providing insight to the investment's risk, with higher values indicating greater variability in returns. So standard deviation, 12.09, 12.61, 10.38. It is what it is. It's actually a little bit lower return, but I haven't really ever figured out how to read standard deviation. Let's go to the last two, the Sharpe ratio. Sharpe ratio measures the risk-adjusted return of an investment by comparing the excess return basically over risk-free rate. So whatever the risk-free rate is, essentially whatever a treasury bill or a CD is paying, let's say right now it's like 4%. What is the risk-adjusted return to its standard deviation? And so that is saying 0.11. That's a pretty low number. So something's changed there, because it used to be 0.36 and 0.42. So something's changed there. I don't know how to read all that. The Trainer ratio is, it measures risk-adjusted return of investment, comparing the excess return over the risk-free rate like before, but we're comparing it to the beta as opposed to the standard deviation. So how much return is earned per unit of market risk? All right, that was a whole bunch of gobbledygook, but it's interesting to ask AI, what does all this stuff mean? And it tells you. And that's where I got that information from, because I only memorized alpha, beta, and R squared. But if I was going to show it on the screen, I had to show like I knew stuff. So there's that. But here's the thing. All these statistics all come from gambling. If we think about it, all of it comes from gambling. How much, if I flip a coin in the air, how many times is it going to land heads? How many times is it going to land tails? Right? And those numbers are directly inverse to each other. That's where it all comes from. Now, let's get back to this part here. What's his name? Harry Markowitz was the one who got the 1990 Nobel Prize in economics based on modern portfolio theory. But the theory is using risk-return statistics. You could do well with your portfolio by sticking to a given risk tolerance parameter. And you just stay the course. That's what he's talking about. Well, it's also assuming that nothing changes year to year. The risk-return model, this is the efficient frontier. It's in concept only, but basically, if you had a portfolio R, you're taking a given level of risk. You want to earn the returns of Q, which is right here, right there on the line. You should be earning more. If you're taking even more risk, if you have a portfolio of U or T, you want the returns of S. You want to optimize the returns for the amount of risk you're taking. That's the idea. Taking all of that I like these scattergrams. Usually a lot of pages have them. Yahoo Finance does not, unfortunately, but like this was a 1-year example. This is a mutual fund compared to an S&P 1500 index, not the 500 index, the 1500. And this has a higher risk, higher return compared to that benchmark. I like that one because at least you're being compensated well for that over the 1 year. This is a 5-year example, and I know it's too small, and this is an old presentation, but I still have it. This is compared to the Russell 3000, I think. But look at this fund way up here. Less risk, higher return compared to that fund. Sign me up for that all day long, assuming that this fund was originally in my risk tolerance. I want less volatility, higher return. It does exist. It's the value investing component. So anyway, again, like we've said, past performance is not a guarantee of future results. And by the way, it assumes that all this stuff, and we touched on this briefly, just because, brought up Trump and crypto, trying to make crypto the reserve currency. That's still a scary proposition. But all of this stuff assumes that life continues with no changes. We have political changes. We have demographic changes. We have economic policy and economic indicators. All of those things change the equation of everything. So nothing is static, especially with this current administration. I don't care if you're a fan of Trump or a big critic of him, everything is changing. And it's hard to feel a sense of security based on current events, which means stay the course. Better to keep doing something than nothing. These are crazy times. So when everything changes, the past almost becomes irrelevant. But at least I can get an idea. How did this fund perform based on the past events? Gives me an idea how might it perform with new events. Not that that's a guarantee, but I like to see what the fund trends to do. So anyway, all kinds of stuff on investing. This has been way too much. I don't think there's much of anything else to cover here, other than there are other ways to invest for the future. You do not necessarily have to invest in securities. I would hope to help people to do more tactical management, which means you're going to take charge of what you want to do and what you want to have happen. When you take charge, first of all, you own your results far better, and you're going to pay more attention, as opposed to, hey, I just did all the stuff my broker told me, and how come I'm lost 30%? Well, you kind of taking a passive role. If you're taking a passive role in your financial planning, you can't get mad when you get passive results. And passive results often lend to hopefully temporary losses. But even then, temporary losses, 2008, it took 5.5 years. Can you take that kind of a risk? And I'm always cautious of that. Now, what are the alternatives? I like cash value life insurance for the reserve fund to then be deployed in however you want to use it. I like annuities, but again, annuities are for retirement. I usually am cautious of them when you're under the age of 50.
Yeah.
50 and over is acceptable, depending, right? There's different ways that these things can work, but like everything, it depends.
Right.
There are so many things. So I think we've covered investments, other than defining what is a stock, what is a bond. We didn't cover that, but a stock is ownership in a company.
Right.
Based on your percentage of all the outstanding shares, you own X percent, usually far less than 1% if you're talking about publicly traded companies. By the way, private, yeah, far less, very much fractional, essentially. If we're looking at private companies, if you're a private investor, you may own stock in a private corporation, which is far harder to transact that business. So, that's what a stock is, but the stock is ownership. A bond is lending. A bond is when you are going to lend your money to a government or another institution, or you're a direct lender to a company, and they're going to pay you principal and interest over a period of time. And it depends on the terms of the bond and all that other stuff. And it's interest rate sensitive. Here's the thing about bonds is that as long as the bond issuer, meaning the company, stays in business and you hold on to your position, you will get all your money back and all the interest, despite whatever the variations are. Problem is, we don't look at it that way. We look at the statement on our balance, the balance on our statements, and we're like, oh no, the bonds went down because interest rates went up. If you hold on to it, you'll be okay. But then if you have bonds in a mutual fund, the mutual fund will make those trading decisions for you. So it all depends. All right, Alonzo asked a good annuity question. What age would you recommend a SPIA? A SPIA can be good at any age.
Well, first off, back up. What for the audience? Let's define or explain what a SPIA is in case they don't know.
Fair enough. Good. I'm glad someone keeps me on track for jargon. I'm usually pretty good on that. A SPIA is a single premium immediate annuity. Now, what the hell did I just say? What it means is that you take a lump sum and you define a payout structure that begin immediately. And the payout structure is either over your lifetime, or it's for a period of time, or a combination of the two. That's what a SPIA does. And for example, let's suppose that someone inherited some money and they want to use the money to purchase life insurance. A SPIA can be done for that purpose. You can set up a 10 period certain, which means 10 payments guaranteed, even if you don't live. So, so a beneficiary will continue to receive those payments. And you use those 10 payments to buy life insurance. And you use it to fund a policy. You can do that at any time. And SPIAs are exempt from the 10% penalty when we talk about qualified plans, because they're already annuitized. So there's different things with them. SPIAs can be very advantageous. Now, SPIAs are also boring. We covered that technical term earlier. They don't earn a whole lot. But depending on how it's being used, I like them being coordinated with other things. I also like them when someone is uninsurable and they want tax advantaged retirement cash flow. Because with the SPIA, and we're talking about outside of a qualified plan. If you do this with an IRA, it's not going to work. But let's do it this way. You use the IRA, you bought a bigger annuity to then use the bigger annuity to buy SPIAs every year. And you use those non-qualified SPIAs outside of an IRA to generate lifetime cash flow. Well, those non-qualified SPIAs have only the exclusion ratio. That's a technical term. I apologize, but we're agents here. We know what we're talking about. The exclusion ratio is about 10% or less of those payments, which will even be subject to a tax form. So imagine if you had a SPIA of $10,000 a year, then 1,000 or less will be counted as taxes.
Sure.
And it takes a huge amount of SPIA income, a non-qualified SPIA, it takes a huge amount to even affect the taxation of your Social Security with the current Social Security rules as they are. So there's definitely a place. So if someone is uninsurable, that does not necessarily mean that they're not going to live a long time. Just means they're not qualified for life insurance. And one of the things I like to being able to do is being able to solve for tax-exempt cash flow in retirement, regardless of your insurability. And so non-qualified SPIAs is a part of that. You just have to buy the new contract every year for 10 years. Oh, darn, I got multiple sales. They're not big commission sales, but I'll take them.
No,
there's
they're not.
worse things in life. So, yeah, a SPIA can be at any age, depending on how it's deployed. An 18-year-old, if they inherited some money and they want to use it to deploy it another way, you can use a SPIA for that. So, like everything, what's our theme? It depends.
I would say on average, though, the vast majority of cases, they're going to be used later in life when you're looking for more of a guaranteed income versus, having your money in the market and things like that. So, generally speaking, you are going to see people 60, 65, maybe and older.
Even older. I think they'll issue them up to age 90.
Yeah.
Even in California. So it's really very friendly for the older that we are. Again, they're pretty boring. The only thing is, and we always have to be careful of them, is that if you choose a life-only payout, the good news is it's the highest possible payout. The bad news is you pass away too soon, the insurance company keeps the entire balance. There's no residual beneficiary benefit. If you choose a life and period certain, then if you pass away too soon, the period certain, whatever is remaining, that gets paid to a designated beneficiary. You live longer than that, it still pays out as though there was no period certain. It just keeps on paying out. So I happen to prefer life plus period certain and figure out the optimal payout for that given amount. And that's something that you want good ratings for, because that's a lifetime contract. If you just want an interest rate play, the interest rate the ratings of the company probably don't matter as much, for short-term MIGA. But the longer that we want that contract in place, I need an A minus on up rated company. I need a company that's going to be around for quite a while.
Yeah, the higher the better.
Yeah, generally speaking. But still, the payout rate is an important factor too, and other terms, definitions.
Right. And that is an interesting thing, is that generally, the higher the rating, the lower the payouts tend to be. But that's probably partially why they have the higher rating, because the money is more secure and they're a more secure company. So,
and basically, they don't need to buy that business. The lower the rating, the more they're going to buy that business by offering something that they otherwise would not be able to do. That's why they've got to offer it that way. So I see a mix of that, but at the same time, if you're not at least an A- rating with AM Best, I'm not touching it. Not for a lifetime payout contract. Hey, we're right at an hour.
Hey, we did it.
We did it, and of course, I went to the deep end, but I had to show off a little bit about some of this stuff. So it is what it is. So the important thing about investing is do it, get started with it, but try to find an investment strategy that works for you. I prefer something far more tactical where you're accumulating a lump sum of money to then be deployed prudently with, and this is the luck factor. Luck is liquidity, use, control, and knowledge. I'd rather have that happen than, hey, blindly trust something and let's just throw it into this fund and hey, it does whatever it does. I prefer something far more tactical than passive. So
yeah. Well, and on this point, if you look at the overall time horizon, and we were talking about market losses and things that can happen throughout time, the younger you are, the more time you're going to have to recover. That's just math, right?
Yes.
So when you're looking at this and that, your age minus whatever thing, that's for bonds and whatever, that's a decent strategy. But the closer you get to retirement, and this is back to your point, in 2008, if you're 5 years out from retirement and you take a 30, 40, 50% hit, and it's taking you 5 years to get back to retirement or to what you had, assuming, and this assumes no distributions, right? Because
right.
you start taking a distribution out of that, and then you're really up a creek without a paddle. But the point is that the longer your time horizon is, obviously the more risk you can take because you have more time to recover. So a lot of people will talk about how just investing in the market and just keep investing and whatever else, and the market always recovers. Well, it does and it doesn't, because it depends on what side of the mountain you're on. And if you're on the wrong side of the mountain when that correction happens, that's where we find people, that thought they were set up for retirement suddenly working at McDonald's again.
And remember, the average time horizon, I'm going to go back to Alonso's question, which is the average time horizon for investors. It depends on what you're saving for. And
Right.
There's a lot of investment ideas where they want to separate or segment your accounts. So here's your retirement accounts, but here's your college savings plans for your kids. That's a different time horizon than your retirement. I mean, I am 47 now. I got 3 kids. One is 21, one's 19, the other one's 17. What's my time horizon for my 17-year-old? 1 year. This is not the same as a 20-year horizon before I'm 67 to retire at full retirement age with Social Security. So that's a different thing. You got to take the different time horizons towards the different goals. And imagine it, now life has happened and I've been an entrepreneur and I do not have the resources that I wish I would have had for my kids. But let's suppose that I did. Imagine a market crash happens 2 years before my daughter would want to go to USC, assuming she could get in. Probably couldn't, but let's suppose that she could, right? Sorry, Rebecca. Okay.
I know your daughter, and she's not, anyway.
Wow. No, I get to say that. You can't say that. Okay, but
she's not going to be very happy with you.
So that's not going to be helpful. But let's suppose that I had a nice portfolio and it went down 30% right before we want to get her into USC. That money's not there, essentially, if I want that money to be there to recover. There's only one advantage of that, which is I could probably write off the losses. But you have to sell out in order to realize that loss. So time horizons, it's important depending on where you're at and what you're saving for and what each account is set up for. And I the nice thing about having the cash reserve of life insurance, for college planning, the whole thing's an exempt asset. It's not reportable on the FAFSA, so that's a good part. That means you can use it and deploy it as much as you want. It doesn't affect your expected family contribution, as we talked about a couple of weeks ago.
And it doesn't even have to be used for college.
doesn't have to be used for college. It can be used for anything. In fact, you can set up as the family bank. You can set up for college, and then you have the student, once they graduate, set up their own repayment plans back to the family bank. And you make it far more advantageous. There's a whole book on that. Was it What Would the Rockefellers Do? Pretty good book on some of that kind of thing. So anyway, I'm coming up at my mental stop here. But yeah, I think we covered so many things, so many of these different considerations on investing and planning. Just got to make sure that people are making informed choices. And things are far more complicated. And the longer I've been in this business, it's simpler and more complicated, which is why we keep saying it freaking depends. So, I don't know. Any final thoughts? I think we covered it almost to death here.
Yeah, no, I'm good. I thought this was a good one. Yeah, it depends, man.
It depends. And this year is going to be a whole nother thing. At some point, once we finish up our financial literacy series, we'll get back into current events, and we'll have to do a year in review for the month at some point. So much stuff going on. So anyway, we will leave this recording at that. Thank you all for watching and listening. Make it a great day. We'll catch you all next week. I don't know what we're talking about then, but it'll be good. All right. Catch you then.
Yeah.
You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not